I want to talk about what I think the real economic crisis in this country is. And I'm not talking about a short-term crisis of is growth faltering? Is there going to be a recession? Is there inflation? Has there been inflation, et cetera, et cetera? I'm talking about the structural crisis that I think we're in. And what I think that amounts to is that the US has for some time been losing the international competition for high value industries and the good jobs, wealth, tax revenues, and national defense capabilities that you get from them. Now, you can see this first in the loss of manufacturing jobs. From 1998 to 2010, 6 million US manufacturing jobs disappeared. There's been some comeback since then. Now, of those jobs that we lost, 3.5 million between 1991 and 2019 alone, which is when some statistics were calculated, are estimated to have been lost due to imports, which primarily means the U.S. trade deficit, the astronomical excess of our imports over our exports. Now, one of the consequences of this have been that real wages for non-supervisory workers in this country have stagnated for about 40 years now. I'm well aware that depending on how you calculate it and whether you include different adjustments for things like benefits in addition to wages, et cetera, you can get a more favorable result. But anyway, there is a big slice of our population that has basically seen its living standards stagnate for a long time now. Now, you can say consumers benefited from these imports. That's, of course, true. But I would argue that the benefits of the imports are not great enough to outweigh the damage that has been done to American industries and American jobs. Now, you got to understand, the lost industries, contrary to what some people seem to believe, are not all low tech. The U.S. runs a $200 billion plus annual trade deficit in advanced technology products. That's an official category that's in the government statistics. These products are made by the very industries in which we, Americans, were the innovators and the first movers, and now we're buying this stuff from other people. Competitor nations have often taken our scientific and technological advances and turned them into new products they make and industries they dominate, jobs they get, profits they get, industrial capabilities that they get, and we don't. Now, as I mentioned, the trade deficit is the broadest measure of U.S. deindustrialization. I'm referring to the goods trade deficit. Services are an important factor, but they're not nearly as big. As of last year, the trade deficit in goods exceeded $1 trillion. That's about 4% of U.S. GDP. Now, because these deficits go back decades, other nations have accumulated over $18 trillion of U.S. assets net of what we own of their assets. So the United States is the world's largest debtor nation. We've been selling off the country piece by piece and sinking into debt to pay for imports because we don't pay for these imports with our own exports. So foreign-owned stocks, bonds, corporate bonds, government bonds are now a gigantic claim on both our future private sector earnings and our tax revenues. I'm interested to see what's going to happen politically when, if this goes on much longer, people finally realize how much of their taxes simply go to pay off foreigners that we borrowed money from. It's not going to be a pretty picture. Now, it has been estimated that our GDP might be as much as 20% greater if we'd had balanced trade over the past 50 years, because this would have been our industries built up, so that's production and income that takes place here. This accumulates in any individual year. It might not mean much, but year by year, by decade, it accumulates. Now, people talk about services. The trade surplus in services, about $200-300 billion a year. It's not nearly big enough to compensate for the deficits in goods. Neither is our surplus. We don't run a surplus in agriculture anymore. We export oil now thanks to fracking. But anyway, all this stuff is dwarfed by the deficit in goods trade. Now, the fact is manufacturing is now a sixth sector in the U.S. As of last year, the share of manufactured goods sold in the U.S. that was made here, which is the best metric of this question, it's under 65%. That's a record low. Labor productivity in manufacturing has actually been declining. I know that's unbelievable, but that's what the statistics say. And I think it's because when you get forced out of industry by industry, when industries are stagnating, when their output is constrained by imports, you're not seeing rising production from the same amount of labor, which is what increasing labor productivity is. We can get into those details later. And a lot of people give arguments that manufacturing is healthy. It actually turns out that these turn on measurement errors. I talk in my book, Industrial Policy for the United States, how one of those errors, for example, is they don't really know how to calculate the value of the computer products sector because prices fall so fast. And this sector bulks pretty large in our productivity statistics. And if you take that out of the picture, then everything good about productivity evaporates. So anyway, it's because of these issues that I wrote with Mark Fastow my book, Industrial Policy for the United States, which is an attempt to explain what you could actually do about some of this stuff.